Okay, welcome everybody to this Wednesday State of the Market from Squire Wealth Advisors. I'm the host today, Nathan Larson. I'm a wealth partner here at Squire, and we are very fortunate to have our friend Sheldon from Focus Partners here to present today on everything that's going on in the market. So Sheldon manages the investment strategy group at Focus Partners Advisor Solutions, overseeing the work they do researching, implementing, and monitoring investment solutions for the firm. He holds an MBA from Santa Clara University and a bachelor's degree in business management from Brigham Young University. He is a member of the Focus Partners Investment Policy Committee and Dimensional Sustainability Council. So with that intro, Sheldon, take it away and tell us what's happening in the markets.
Great, thank you. It's good to be here. Let me just share some slides here. Can you see that?
Yes.
All right, great. So what I thought is just wanted to go through and talk a little bit about the first quarter, what we're seeing there, although I know it seems like a lifetime ago given what's happened in April so far. So I'll touch on a little bit of that as well. Talk a little about the economy, inflation and Fed policy, tariffs, although that's pretty fluid, the situation. So what I will say is these slides were updated as of the end of the quarter, so the situation's changed quite a bit, so I can talk a little bit about that as well. And then also wanted to touch on international diversification because it's something that we're starting to see as a benefit within the portfolios. We're seeing a reverse in what's been maybe a decade-long trend of U.S. exceptionalism. That tends to be the buzzword for what we saw with U.S. markets just really doing really well. We're seeing international. And so I want to talk about international performance a little bit and diversification. So with that, just a brief update on the market for Q1. The quarter started out really with a lot of momentum in equities. That was fueled by economic outlook that was good. We saw strong indicators in the market, a pro-business environment, policy environment, as well as advancements in AI. There was a lot of buzz around that. That was kind of short-lived, though, that momentum, as talks of tariffs and trade policy started in, February, approaching March and April. That implemented or introduced a lot of uncertainty into the markets. Markets hate uncertainty, and as we saw a lot of volatility, and markets start to decline and pull back as a result of those trade discussions and tariffs. So looking at performance for the quarter, we saw U.S. markets were down roughly close to 5% for the quarter. International markets, on the other hand, though, were positive. When we look at broad international developed markets, up almost 6%, emerging market stocks up almost 2%. Once again, this reverses a trend that we saw last quarter, as well as pretty much the past decade of the U.S. market really doing well and outpacing international markets. We did see U.S. bond markets positive, international bond markets relatively flat for the quarter. I do want to turn your attention, though, to the bottom line here that is the past 12 months performance. Sorry, going back. You can see here, performance has been positive across the board for U.S. stocks, international and emerging markets, as well as U.S. bonds and international bonds. So I know there's been a lot of uncertainty in the markets recently, specifically the month of April, and markets have been down, a lot of volatility, but it's always important to keep sight and keep focused on the longer term. And we do see that longer term performance, even the last 12 months, has been positive across the major market indexes. If we dig a little deeper and drill down into these indexes, we see some interesting trends as well. U.S. market down, as we talked about, U.S. large value stocks, and that is something that we allocate to within our portfolios. We like to allocate or target value stocks. U.S. value actually did pretty well for the quarter. Is up 2% compared to the rest of the U.S. market, which was down. Small value is down significantly. Over 7% for the quarter. But once again, on the international side, we saw developed markets up, international developed value up almost roughly 10% for the quarter. International small value up almost 6%, and emerging market stocks up almost 3%. Once again, focusing on the longer term, we're seeing positive returns in most of the major asset classes. I would say U.S. small value is the one that struggled a bit there over the last 12 months to 3 years. But beyond that, looking at 5 years, performance is really strong there. Looking at fixed income and other alternatives, we see U.S. fixed income, once again, treasuries up, tips up as well. Those all up over the 12-month period. And we saw real estate positive for the quarter, as well as commodities doing pretty well. I think a lot of the uncertainty, there was a flight to commodities there that really drove those returns, with commodities being the strongest performer on this slide over the last 12 months. I want to talk a little bit about market drawdowns. There has been a lot of uncertainty. We had a significant drawdown in the market through for the first quarter, as well as the month of April. We started to see a pullback in the market. It's not uncommon to see a pullback in the market. This chart here shows the annual returns since 1980 for the U.S. market. The dots there represent the intraday or pullback that we see in the market during that year. And you can see the average is roughly 14%. So what that means is during any given year, the market on average pulls back or goes down roughly 14% during that year. And if we look at the most recent, what we had here, this represents the pullback. We got down almost 20% at one point. I looked today, I think we were down, that had gone back. We're down roughly 3% year to date. So once again, when we're living through these declines, I know it's not fun, it's not comfortable, but you have to keep your perspective on the longer term. Pullbacks are common. If you look at this here, I went back, I don't think there's has ever been, at least in this from 1980, any of these periods where there was not some type of pullback. Sometimes they're small. You can see like in 1995, roughly 3% pullback, and that was a very strong year. That year, 2017, we saw a pullback of 3%. So sometimes they can be moderate, very uncommon that you get strong, positive performance at every point during the year. There are always pullbacks that we see at some point during the year. And even if there is a pullback, you can still have a positive year. If you look at 2020, we had a 34% decline, yet the market finished 18% up for the year. So once again, pullbacks, not uncommon. They happen every year at some point. I know they're uncomfortable. They're not fun, but it's always important to stay focused on the long term, because those pullbacks can change. And you can see, the recent pullback that we've had being down almost 20% at one point. It's, now 3% down, I think, is what the S&P is the last time I checked. Let's turn to economics. The one thing I will say is my crystal ball is always very cloudy. So I'm, when it comes to prognosticating in the future, what that holds, I really have very little idea. And to be honest, I don't think anyone knows. Very difficult to try to forecast where things are going. But there is some information that we can glean from economic data about the future. And if we look at it, CPI or inflation, up here in the top right, you can see inflation has come down quite a bit from where it was, in 2022, 2021, where we had some really high inflation there for a while. It's come down to a more manageable level. You can see GDP growth, although it was slowed a little bit, still positive. Unemployment looks pretty good, pretty low, around 4.1%, around those historical lows. Jobs, the job report was looking positive there as well. So some good economic indicators as we got towards the end of the quarter. But what I would say there is there are some signs of stress in the economy. So it's not all a rosy picture. The University of Michigan, they have a consumer sentiment survey that's widely followed in the industry. And what I would say there is they saw some things that were starting to turn. Consumer sentiment, they saw declining rapidly. There were worries about jobs, the level of security, potentials for recession in the future. Um, there was, sentiment of business conditionings worsening, household income expectations, the expectation there of declining, expectations of rising inflation as well in that report. So what I would say is, even though the last slide, it looked like the economy and the indicators were pretty strong or in a pretty good position, there is some signs, at least forward looking from different surveys, that some of those things and some of the sentiment is changing. What does that mean for the Fed and Fed policy? If we look at the Fed targets for inflation here, you can see they're close to what the Fed target is. That dotted blue line is roughly 2% inflation. Depending on the different measures that you're looking at, we're running a little bit hotter than that, but not much. It's still within distance or within arm's length of the Fed target. So if we look at what that means for the federal funds rate and the Fed raising interest rates, usually what will happen is if the economy heats up or inflation starts to increase, the Fed will likely raise those interest rates to try to moderate that inflation. Um, you can see here as the expectation with inflation being low and the volatility in the markets, there is some expectations that the Fed would lower interest rates to try to stimulate the economy at some point. They are in a bit of what I would say a precarious situation, as Chairman Powell's mentioned, right? Because with the markets going down, there's expectation that they would lower rates, but they're really watching that inflation, because if we get some inflation, specifically as a result of some of the tariffs, it puts them in a tough spot to actually lower rates. Because they would want to raise rates to kind of combat that inflation. So will be interesting to see what happens with the Fed and what direction they take here in the future. Just commenting here, the Fed funds rate, that target is sticky. They're doing pretty well managing that. Once again, I think it's current inflation is within arm's length of their target. What will happen in the future? I think it will be something to watch depending on the markets and the pullback that we get there, and inflation as a result of tariffs, which way the Fed takes with its Fed funds rate target. Tariffs. So this was updated as of March. You can see this is outdated, ancient history at this point. The last we saw with the tariffs is Trump had implemented basically a 10% tariff across the board. I think it was 145% or 125%. Let me see, I've got it in my notes here. Sorry, 145% tariff on China. That really caused a lot of volatility in the markets. There was a pause on the tariff. So at this point, it's really a wait and see as far as tariffs are concerned. I know that the administration, what they've indicated is they really want to try to negotiate tariff rates with our trade partners. So what actually will get implemented at some point, I think there's a lot of uncertainty. We just don't know. So we'll have to wait and see what happens there and the ultimate impact that will have on markets. What I would say is, consensus is that there's going to be probably lower GDP growth. I think we're going to end up probably with some types of tariff in place. Depending on how negotiations go, there may be some residual tariffs that are in place with certain countries, certain industries, et cetera. That's going to, creep up inflation, would have its impact. I think there's going to be a pullback in GDP expected for, China, and higher inflation for them. So ultimate impact, tough to see what those actual numbers would be. This is projections as of March. What I would say, there's probably some expectation with the trade negotiations and things that will happen. If there are some residual tariffs in place, we're probably going to see a slight slowdown in GDP, probably a slight increase in inflation as a result of those tariffs. Just to wrap up here, I want to talk a little bit about international market diversification, because we are seeing, as I mentioned, a reversal in the trend that we saw of this American exceptionalism. We're seeing international markets doing well. If we look at the global market cap, it's historically been around, or we've targeted 60-40. within our portfolios. That's kind of where the global market cap, US versus international, has hovered. You see we're almost at 64% on the US side, 25% international developed, and 11% emerging markets. If we look at performance by decade, this chart here shows the blue is the US stock market, the yellow is international, and that pink is the difference. And those pink periods, if they're positive, that means the US outperformed. If they're negative, international outperformed. And you can see in the 70s and 80s, we had strong periods of international performance. The 90s, US did very well. 2000s, performance relatively flat, but the international did outperform. But if you see the 2010s, 2020s, we got into that period once again of this American exceptionalism, where U.S. markets really just did very well compared to international markets, and folks started to question, does it make sense to diversify internationally? Well, I think if you look at valuations, and this chart here shows the relative valuations of U.S. Price to equity ratios versus international, and you can see currently U.S. price to equity valuations are roughly 2 times what they are for international. So what that means is you're roughly paying double what you're paying for a dollar of earnings in the U.S. than versus what you're paying for a dollar of earnings in international markets. So valuations, what we tend to see over time is, when they get really high, they tend to pull back, right? Because there's, an expectation there of rationality. If things get too overvalued, right, there would be some pullback there. So we're seeing that these valuations got really high on the US side relative to international. And the reason we saw that is market concentration. If we look at the top 10 holdings within the US market, you can see this chart here, which shows that percentage of the top 10 in the US market over time. It's averaged about 20%. We're up closer to 36, almost 40% of the top 10 companies make up the US market. That's a big number, right? If you think of 10 companies representing almost half of the market and market performance, you can see the risk there, right? And in that concentration, the risk being if those companies pull back, that's really going to impact the market return. The other thing you can see here on the right-hand side, I would say, is the concentration that we have in technology. If you look at June 2000, right, there was a little bit more of diversification in the makeup of those top 10, right? You see pharmaceuticals there, you see petroleum, oil, you see, staple consumer goods with Walmart, things like that. Just banking with Citigroup, you saw a lot more diversification. When you look at the current makeup of the top 10s, it's pretty much technology. So a really big technology makeup there. And so there is a lot of risk being over concentrated in the US market at this time. Which is why within our portfolios, we like to diversify. And you can see this chart here, which shows the performance year by year of the major asset classes. You can see that the US has done pretty well, right? 23, 24, very strong years for the US. It was the top performer. 2019, 2020, also very strong years for the US, being the top performers. 2021, really good year for the US, being one of, not the top, but one of the top performers. But that doesn't mean that the US is always going to be a top performer. You can see, looking at this chart going back to 2005, it was really those 4 years, 2019, 2020, 23, 24, where it was at the top. There have been other times where other asset classes have been at the top. Real estate certainly had its time in the sun, being the top asset class in different years. So it's important that we always want to diversify and hold a mix of these asset classes, because you can see the 60-40 index mix, it's always kind of right there in the middle, right? Because it's got a mix of everything. It's got stocks and bonds, domestic stocks and international stocks. And you can see it gets pulled, it gets pulled kind of up and down, but it's always right there in the middle. So You're not going to, using a baseball analogy, since we're getting into baseball season, you're not necessarily going to hit the home run by being diversified, but you're not going to strike out either. And that has a significant impact on your retirement and your nest egg that you're going to pass on potentially to heirs, because those strikeouts that you get in retirement can have a significant impact on your wealth and your ability to pull income from your portfolio over time. So with that, I'll pause there and we can open it up to questions.
Thank you, Sheldon. Just had one question come in so far. So if you're watching and you have a question for Sheldon, go ahead and type it in to the Q&A up there at the top, and we'll try and answer that question. But the question we received was on the real estate market, and construction. It seemed like transaction and deal activity was starting to pick up, and now maybe the uncertainty is causing firms to pump the brakes. What are you seeing in that industry specifically?
Yeah, so as far as tariffs and the impact on that industry, I think there definitely is potentially significant impact, which is why we're seeing the brakes, getting pumped on some of these construction projects and things like that. As the uncertainty of tariffs, a lot of those goods that are being used in construction, right, they're being imported. As those costs go up, building costs go up. A lot of times you might have fixed costs, you might have fixed contracts and things. So as those variable or those costs go up, that impacts the profitability and things. So I think it'll be interesting to see what happens. I think eventually things get worked out, but yeah, there's probably some pause that we see for a time as the uncertainty is there. Once that uncertainty starts to go away, things become much more clear. I think you definitely could see that activity start to take off again, for sure.
Yeah, yeah, it makes sense. How about the with the tariffs and inflation? And I know the Fed has a really tough job, and it seems like there might be some tension building between, uh, Chair Powell and the president.
Yeah.
What are the expectations as far as interest rates go? And with the inflation, it seems like maybe a quarter point decrease this year, or maybe up to a half a point still expected, or is that really still uncertain now with the tariffs?
Yeah, I think we track this, and I think the one thing we see is that we're expecting probably at some point the Fed to lower rates a bit, just given the markets and the pullback. But once again, with the tariffs, that does put them in a little bit of a precarious situation, because if we see tariffs implement and that cause a lot of inflation, it would be really tough for them. But I think markets at this point, we're kind of expecting a slight pullback in rates, but once again, be interesting to see. I think in Powell's last comments, I mean, he mentioned a lot of uncertainty there as well. So, and I think you kind of hinted at it a little bit. There's a lot of uncertainty as to, well, will he actually even be around? Just given some of Trump's comments. So a lot of uncertainty in the markets at this point. And as I've commented, markets don't like uncertainty. So it'll be interesting to see. I think at this point, the best strategy, right? Just stay diversified. These are the times where you really want to be diversified, because if things are never clear, but if things are less clear, I would say now is a time where the things are really unclear as far as what will happen in markets. So really a good time that you want to be diversified.
Yeah, yeah, thank you. Okay, another question coming in about foreign companies investing in the U.S. and any insight into how that might impact U.S. equities.
Yeah, so as you have foreign companies come in as a result of tariffs, and I think that's ultimately what the goal is with some of these tariffs, to get some of those producers to onshore a lot of this production. Really tough to say what the ultimate cost will be and what the ultimate impact would be on equities. The one thing I would say is these things are very, very complicated, right? And when you think about sometimes there's very simplistic explanations that are given, especially if you're watching things in the media, things like that. But these things are very complicated, so very tough to tell what will happen. They could bring things onshore that potentially could increase costs. Does that slow down consumer demand? I mean, really tough to tell, because that also could impact, right, wages and things. You have more jobs, more people able to consume. So there's a lot of give and take there, which is why with these tariffs, so much uncertainty, and why the market's so volatile. I think it's just really hard to see what the ultimate impact could be.
Yeah, yeah, that makes sense. It's interesting the uncertainties there, but it also like the media always wants to have one answer for the
Yeah.
decrease in the market, and really there's thousands of moving parts, and
Yes.
there's not really ever one answer specifically that's impacting everything. So,
Yes, absolutely. I think there, a saying I always say is, when traders trade, you don't file an explanation report. Meaning, if I go out and sell a stock, I don't say why I sold that stock. And market moves are the result of everyone's buying and selling. And I always kind of chuckle when you hear the talking heads saying, "Hey, the market went up because of this or went down because of that." Honestly, no one really knows. You can speculate and guess, but there's so many factors at play. You'd have to survey every person and ask them, "Why'd you sell?" And you always have to remember there are two people on every transaction. So for every seller, there's a buyer. So you always got to kind of take those comments as a grain of salt because there's so many factors happening at any one time.
yeah, yeah, for sure. Another question coming in about allocation changes. So, with the uncertainty, is the investment policy committee recommending any out of ordinary or unusual market allocations or investment allocations? Or do we really want to just stick to, what's right for our individual clients?
Yeah, so you always want to stick to what's right for the individual client, right? So you have to look at your needs, your wants, your wishes, right? When you're making portfolio allocation decisions, as well as your risk profile. How much volatility, how much up and down fluctuation in the portfolio can you really stomach? Because if you have a portfolio that is more volatile and subject to much more fluctuations than you actually feel comfortable with, then it's probably not the good portfolio, right? You don't want to lose sleep at night. Because what happens is a lot of times when those fluctuation comes, the inclination is I need to get out of the market, and that could be the worst time to make a change and get out. Well, what I would say is, these times in the market, they're a good gut check, right? To determine, am I really in the right portfolio? If you're not feeling comfortable, maybe you want to go back and revisit that risk tolerance, how comfortable you are with downside fluctuations and things. But making a portfolio change just based on volatility, probably not the best strategy. You have to remember these scenarios have already been played out in your plan. When we're running planning scenarios and we're running Monte Carlo simulations and looking at the viability of your investment portfolio and your plan, these types of pullbacks, these types of markets are factored into that plan, right? So we've already considered this. We've already taken it into account. So this isn't something that is catching us off guard. So that's one thing I would say is when you're living through these types of markets and environments, remember, we've already planned for this. We've already looked at these scenarios and the impact on the portfolio. The one thing I would say though is, there may be some changes that you want to make. The one thing you can control, because you can't control markets, but you can control spending, and that has a big impact on the output of a plan. So maybe there's maybe you pull back some spending a little bit. Maybe, you don't buy the new car. Maybe you don't take a certain trip or that extra trip, right? Those are some things that you can look at that if you want to change the impact of the plan and the viability of the plan, spending is always one of those levers that you can pull that has a lot of control on the outcome of the plan over time.
Yeah, yeah, great. Also can, yeah, all those life changes, you can work a little longer, you
Yeah,
can, yeah, there's lots of things we can do to
yeah,
help there. And these things are temporary, right?
yeah,
They've always been temporary. We expect them to be temporary, and the volatility, or what we sometimes call risk,
yeah,
it's really just the price or the cost for being invested
yeah,
in the market, and that's what you have to do. You have to go through
yeah,
those to get the reward, right?
yeah, absolutely. And if you live through April, right, you paid the price, right? So
Yeah.
tough to abandon that at this point, right? You've already kind of paid the price. You might as well hang around to get the return at some point.
Yeah, and April's a really good example. I mean, there were so many days where it was some pretty big increases. If I
Yes.
remember right, there was a record increase
Yeah.
for the Dow, I believe. But if you're not in there, you're going to miss those increases, and
Yes.
and that's just really hard on the long-term outcome.
Yeah.
Um, so international diversification has been helpful recently. With the small values still kind of struggling. What are the expectations there, and do we feel like that's going to bounce back and get back up to averages eventually? And if any idea when or how long we have to hold out till we can see that small cap value premium show up?
Yeah, so it's small cap value. It has been a struggle. It's one of the allocations that we allocate to within the portfolio, and it really has. It's been a tough, decade, even 2 decades when you look at the numbers for small value. The interesting thing is when you look at the valuations, right? The U.S. large growth is really, I mean, valuations are really high versus what they are for small value. Small value valuations are roughly what they've been historically. Personally, I thought with the pullback that we saw with large growth in April, I thought we would have seen more of a small value premium, but we didn't. I think that's because of a lot of the uncertainty around tariffs and what's happening there. But if you think about it, right, it's risk and return are related, and those are riskier baskets of stocks, right? And so we would expect a higher rate of return there. We haven't been earning it, right? We've been paying that price, that pain, the underperformance, but at some point we would expect that we'd earn that premium there. And as you mentioned, those returns can come very quickly, and we tend to see that in small value. The returns will come in spurts. So it's very important, even though it's probably been one of the lower performers in recent history. It's when the performance does turn, it's probably going to turn pretty quickly. So if you're not holding it in your portfolio, you're going to miss out. And by the time it shows up, it's probably too late to jump in and get some of those return premiums.
Yeah, yeah, you just kind of have to be patient with it, right?
Yeah. Yeah.
Okay, we have the S&P 500 that's used a lot for kind of a proxy of the US market. What kind of indices or investments are out there for somebody that wants to just start diversifying internationally a little bit more?
Yeah, so as far as indexes, MSCI they have a suite of indexes that we typically use. So the MSCI ACWI, some of those, they've got a really good set of international indexes that you can use. Within our portfolios, we use some of those ETFs that are broad-based market ETFs that target those international markets. We always like a value tilt or flavor within the portfolios. Once again, you're buying something that's more fairly priced versus something that like a growth strategy, which tends to be more overpriced in our opinion. So we like those value tilted strategies, and you can get those through different funds that we offer within the portfolios as well. Once again, we want broad diversification. What I like to say is we like to hyper diversify because we just don't know which companies, which industries, which sectors are going to be the outperformers going forward. And so we want to own as many of those great companies as we can.
Yeah. Yeah, it makes sense. All right, one question kind of coming in about commodities. So, commodities, the broad basket of commodities kind of being a worst performer 10, 20 years if you look at that time span. But given JP Morgan's recent forecast that gold will hit 4,000 an ounce, how do you see gold playing into future portfolios, and what's the best way to kind of get gold into a portfolio if an investor wants to?
Yeah, so as far as commodities and gold in particular, yeah, commodities we've seen really good returns recently, and they were underperformers for a very long time. I think part of it is when you see stress in the markets, there's a tendency to a flight to commodities, right, as a hedge, especially gold and other precious metals and things like that, right, just to protect wealth. They're seen as something that that can be a protection there. As far as gold in general as an investment, this is something I was told when I first got into investments and first went to school. My first professor, he was a stockbroker. He got on the topic of gold, and what he said is, if you go back 100, 200 years, how much would it cost you for a nice Italian suit? It was roughly an ounce of gold, right? If you look at the price today, yeah, you could probably get more than a nice, although I don't know, nice Italian suits are, they'll run you a couple $1,000s. So gold over time tends to keep up with inflation. There's some spikes up and down, but if you're looking at long-term wealth creation and preservation, it's really not going to create any wealth for you. It might protect some wealth or keep up with inflation, but that's really over the long term what it does. I think a lot of the run up that we're seeing in gold, right, is that speculation and that fear of people wanting to get out of the markets and look for a safe haven. But like I said, once things become more transparent and clear around tariffs, volatility tends to settle down. I think you're going to see kind of the exodus out of the gold potentially as people, right, rush to equities to earn those higher rates of return. So it could be something you wouldn't want to be in there stuck holding the bag per se. As far as an allocation within the portfolios, it's not something we'd specifically target. Once again, it's not a creator of wealth per se over the long term, and it doesn't really um, provide you like any income or anything like that, like you would get out of fixed income. So not something we specifically allocate towards in the portfolios.
Yeah, yeah, that's good. I love the analogy of the suit. I've heard that go back as far as to Christ's time when,
Yeah,
a Roman centurion could buy a nice set of clothes for an ounce of gold, and
yeah,
today you can buy a nice set of clothes for an ounce of gold. So
yeah,
it's held value, but it hasn't created wealth.
yeah,
And really, it doesn't produce any revenue or income, like you
yeah,
said. So you'd much rather, as a long-term investor, own a business through a stock that
yeah,
is out there trying to generate profits on your behalf. So,
yeah.
yeah, good explanation. Well, that seems like there is one question about options. Do we include any options in our allocation? And if so, why? And if not, why not?
Yeah, so within our portfolios, we don't have any options per se or option strategy. There's options really are insurance contracts, right? You're looking to insure either upside or downside move. You can use them within a portfolio context if you're looking for some protection. What I would say is they are volatility plays, so they become very costly if you're trying to buy them during high volatility periods. There are strategies that will sell options, so you're basically an insurance seller. We do allocate to some of those within some of our alternative strategies. Those can be good diversifiers that are uncorrelated with equities, and they tend to be a risk premium there as well. But individual options, we're not targeting anything like that. Once again, it can be very costly. The other thing is options. There's zero sum games, right? So there's always a winner and a loser.
Yeah.
And if you're on the losing side, you could get wiped out. So you have to be very careful with option strategies, what you're doing there. Once again, we look at them more as insurance vehicles, right, on equities. So if there's a certain, downside that you need to protect, things like that, yeah, options may be a viable solution there, but probably going to be pretty rare cases, and a lot of times can be very expensive to implement those insurance strategies.
Yeah. Yeah, for sure. Um, Maybe the last question here. If I, want to work with Squire Wealth Advisors and hire them as my financial advisor, how does Focus Partners and your investment strategy help or impact what I do with Squire Wealth Advisors?
Yeah, so Focus Partners, we support advisors like Squire Wealth Advisors. So we give them, investment philosophy, investment planning tools, resources, et cetera, to help build out their team. So really, if you're working with Squire and they want to use one of our Focus Partners portfolios, they can use that as well as our planning tools, et cetera. So we just help make them, more effective, more robust at doing their job as a financial advisor. They don't necessarily have to work with us, but if they want to, if the philosophies align, then they're welcome to partner with us, use our tools, services, etc.
Yeah, thank you. Yeah, we've enjoyed our partnership with Buckingham and now Focus Partners with the name change. And yeah, you do a lot of good work for us and for our clients. So thank you. And I would just leave. Thank you for joining today, and leave with maybe a little bit of optimism. We don't know what's going to happen day to day in the markets, but over time, if you stick with your plan, long-term history shows us that investors get rewarded. So stick with it. If you have questions or concerns or need to talk to your advisor, reach out. We're here to help you and always available to chat and meet with you. So have a great day, and thanks again, Sheldon. Um,
Thank you.
okay, we'll see you later.